And welcome to the VSA Capital Tech and Transitional Energy Podcast. It's Thursday, the 9th of September. I know it's Thursday, the 9th of September, actually, because, and we may talk about this a bit later, actually, it is actually the IPO day for VSA Capital. So it's sort of well and truly in my memory. Anyway, look, today we've got Phil back. He's come back from holiday. How was your holiday, Phil?
It was very nice, Andrew. I had a very good time up in Scotland and getting some golfing, and it was lovely.
God, we let you have a good life here, don't we?
You do.
Anyway, whilst you're away, we did obviously do a special podcast that was with Johnson Matty and Sam French, who is their sort of hydrogen guru around there. So we may touch on hydrogen again a bit later in this podcast, but actually just finishing off on the VSA IPO. We did, of course, IPO on the Aquis Exchange, which we regard as the growth market in London and very much technology led, and the way you do your admission documents and everything is done is it has a much more technological edge than the London Stock Exchange. And of course, by doing it using technology, it takes less time, which is good. Less time means less money. So that's one of the reasons why we're such a big fan. But that's probably enough on VSA Capital. Now, the other thing we've been doing this week, which I think is relevant and probably some people follow a little bit about, is we've been doing a roadshow with Invinity Energy Systems. And it's been a fascinating roadshow, actually. I know, Phil, you've sat in some of the meetings as well. And it's been great to have Larry Zulch, the CEO, actually over from San Francisco to be able to talk face-to-face to people. And do you know what? I'll tell you one thing. You learn so much more when you're sitting face-to-face with somebody than you do on a Zoom call. It's extraordinary. But, you know, the things that have come up that I would highlight, and I'll be interested in your comments as well, Phil, are, you know, we started a lot of the meetings with trying to get into people's mindset that what Invinity has achieved now is that it's basically turned itself from a prototype company to a production company. And the difference between a prototype company and a production company is a prototype company makes specific machines or batteries or anything else that is tailor-made to the client's demand. A production company is more like the Model T Ford, where the client gets what you make. It comes off the assembly line, and that's what you get, guys, and this is the price. And it's actually when you become a production company that you actually create the real value. And if you look at, for instance, let's take Tesla. If you look at the share price of Tesla, it went nowhere whilst it was just a prototype company. But when it came up with its first production model and it said, that's what you get, guys, you know, take it or leave it, and that's the price you pay, the share price went ballistic. Truth is, Invinity Energy Systems is now, and it's happened, I would say, in the last few months, a production company. And, you know, we're also going to see their first systems go into the Energy Super Hub Oxford. They're sort of there. They're just waiting to hand over the keys to the controllers of the Energy Super Hub Oxford. When they do that, you know, there it is. It's up and running. It's working. And I think the order book will absolutely open up and it will be quite stunning. But that was one of the things that really I thought was fascinating in the conversations we were having. But what about Phil? Was there anything you took away from that?
Yeah, I mean, it just for those who don't know, Invinity Energy Systems, corporate client of ours, the ticker is IES, and the market cap of this is £100 million, which, as we get to this, does to me seem extremely low. It's an energy storage technology company, so it has what's called flow battery technology. And that battery technology can be used being widely used in the grid, where it has applications, because if you've got, the sun shines and then the sun goes in and you need battery storage to back up the grid. So we've seen, lithium systems used around the world, but this is a flow battery system. And what it does is it can charge and recharge over multiple cycles and over longer times than lithium. And it has a longer life as well. Now, why is this whole area of battery storage exciting? And what we've talked about an awful lot is because, there's a report from the California Independent Systems Operator. I don't know if you saw that, Andrew. It's this week. It's called CAISO is the acronym for it. And Invinity is working with CAISO in California. And they said last year that they had 550 megawatts of storage on its system. And that has grown now to 1,500 megawatts and expects it to top 3,000 by the end of the year. So this whole area of battery storage.
Well, it's gigawatts, isn't it?
Yeah.
I'll tell you another story. Here's a little story, which again, listeners may not have heard. But the California Energy Commission actually ordered 100 megawatts of Tesla, basically lithium-ion batteries, and they were being shipped out of Shanghai round to California. I think it was back in June. And as unfortunately lithium-ion batteries do, they caught fire on the ship when it was steaming towards California. And they couldn't put the fire out, so the captain basically turned the ship around back to Shanghai. Battery still burning, and they took all the batteries off, the whole bloody lot, and said, we're not touching any more. We're not putting any more lithium-ion batteries on our ships. And so, unfortunately, California was a little bit stuck, didn't get its batteries that it needs badly. And I think it'd be fair to say, and we'll sort of watch this space, the California Energy Commission now needs to replace 100 megawatts worth of lithium-ion batteries with something they can actually get hold of.
Yeah.
But again, you know what, Phil? I've been criticised a few times on this podcast for saying that certain companies are overvalued because they're just a science experiment. This is the new word, actually. They're overvalued because they're just a prototype. What you've got to do is to get a real valuation is to be in production and to offer a standard product that you can just roll off the production line. And that, in my view, is why Invinity is so cheap. I'm going to tell you one other thing I picked up on this trip, and then we should perhaps move on. And that is, and I thought this was fascinating, actually, and it's come out of the whole sort of Siemens-Gamesa relationship that Invinity have, which I don't think the market has realised just how massive the opportunity is here with Siemens-Gamesa, and it's going to be huge. But it was brought up in conversation about, what the relationship was between ITM and Invinity Energy Systems, which a lot of people probably aren't totally aware there is a relationship there as well. But what the point is that clearly, ITM with their fuel cells and the electrolyzer are trying to create green hydrogen. And green hydrogen is what you need if you're going to be carbon free. All the other colors basically are not carbon free. To create green hydrogen, you've got to have renewable energy. Now, that's fine, but if you're running an electrolyzer and fuel cells off renewable energy, you've got to have a constant flow of that energy, or else it messes up the whole thing. The only way to get a constant flow out of wind farms and solar is to have energy storage alongside it. And the reality is, this is why it seems one of the things that Siemens Gamesa want to do is they know they've got to have the energy storage. So they're going to put all these Invinity flow batteries, and actually it links basically Siemens Gamesa's wind farms to the ITM electrolyzers and fuel cells. Invinity sit in the middle. Without them, it can't happen. Now, look, somebody said, well, when does ITM buy Invinity? And actually, Larry sort of went around, no, that's the wrong question. The question is, when do we buy ITM? And it's when we, it was a bit of a joke, by the way. But people have got to understand, actually, some of the complexities of this and just how valuable this part of the jigsaw puzzle really is. But that really hit home to me. ITM doesn't work without Invinity.
Yeah.
Quite a punchy statement, man.
You are, but very, very true. Very, very true. And look, apologies to listeners if we're getting excited about this whole area, but sooner or later we're going to see in our gas bills the latest impact of there's been a global shortage of natural gas. In this country we've had calm weather, not enough wind being generated, and we've actually, the UK's had to fire up one of its coal plants. So, this we can see the impact of the change in the energy mix into the grid from renewables, and see the need for battery storage. There's a lot happening.
Yeah. Anyway, look, I'm sure we'll be talking more because we always do, but it is such an important area. And obviously with these bills going through Congress and the Senate in America, $1 trillion bills, the numbers are just incredible. Now, I'll tell you one other, moving on completely into a different area, maybe a bit random. I'm sure you've got things to talk about, Phil, too. But I saw an intention to float from a company called Fugo. Did you see that one, Phil?
Yes, I did. Yeah. This is a cross-border e-commerce technology company.
Yeah, and we're very interested in cross-border e-commerce, aren't we? I mean, look, it's obviously we know that cross-border e-commerce is going ballistic. I'm sure this is a Pamela Gordon float. I'm sure it'll be hugely successful. But of course, it all relates to a certain extent back to our client, Samarkand, doesn't it?
Yes, it does. Yes, who have a cross-border e-commerce platform, and they are serving the largest global e-commerce market in China.
Yeah, so I think what I suppose the point from this is I'm sure Fugo will be a very successful IPO. I'm sure it'll come at a massive rating. But what we're also seeing at the moment, I don't know if you spotted this, but a lot of these businesses that consolidate, should we say, the marketplace to access things like the Amazon marketplace. There's also a massive amount of work, or transactions going on there. It's becoming a very crowded space, actually. But the multiples of these things are huge, aren't they?
Yeah, in terms of the valuations, yes, they are. And that is because of the ability to scale them, Andrew. And I think it's super that with Samarkand and obviously with this one, that investors have got an opportunity to be involved in the UK. In this whole area. But you go and look to the States and NASDAQ and look at Shopify and look how that scale globally as a business. And this is why these things trade on good multiples.
Yeah, Samarkand, what it's worth, had their AGM this week, actually in our board meeting room. But it's all fine. I think the news flow coming out of them towards the back end of this year could be very interesting. But we'll obviously have to wait and see what they have to say. But I think so far, everything they've done since IPO has been exceptionally good. And I think that will carry on.
Good to hear.
Anyway, okay. Well, what would you like to talk about, Phil? Come on, you've just been away on holiday for 2 weeks. Give us some inspiration.
I've been catching up on company results, and we'll get into valuations here as well. So let's look at. I mean, for instance, we had interims out from Computer Center. Ticker is CCC, and it's a 4 billion market cap company. It's one that we have talked about before, and this is an IT services business. So they have multinational clients, and they provide IT services, right? So service desks, enterprise mobility, security solutions, software solutions, cloud communications, all those IT things that you need. What's quite interesting about Computer Center is obviously businesses are coming back, they're spending money on IT, and as we discussed, Andrew, I think it's a cultural change through the pandemic, and that has been that right across organizations now, they really do appreciate the value of IT and what it can do. So spend has been coming back, and they report their interim revenue was up by 29%. And I think most of that was organic growth. So a really strong sort of recovery in spend from clients there. And their profit before tax went up even further. That was up by 59%. Now this sort of getting onto valuations here, things. This trades on an EV revenue multiple of 0.5 times, an EV EBITDA of 10 times, but the gross margin is 13%. So with something like this, it's on lower multiples, but then it's generating lower margins. But what's been interesting about this one and why we've commented on it is this, in terms of recovery play and as the economy itself recovers as well. And again, what caught my eye with this is how well they've been doing despite all of the supply issues around IT kit, semiconductors, you name it, logistics issues. So I thought that was a good set of numbers from them.
They're up 3% today, so the markets obviously agree with you. And actually, they're up about 22% since the start of the year. But again, actually, if you look at a chart going back to 2017, which was some way before we entered the pandemic, though they were down at sort of 10,000. They're now at 30,000. So it's been a really nice performer, actually, and it clearly got momentum behind it. So I would agree and endorse everything you say there, Phil.
Yeah, okay. Moving on to something that's valued on far higher multiples. Frontier Developments, the ticker is FDEV. It's a $1 billion market cap, and this is a games developer. Now, they generate a gross margin of 63%, and it trades on an EV to revenue multiple of 7.4 times. EV EBITDA of 19 times. So, but the market's forecasting, if you look on Bloomberg, 18% growth for this. Now, they've reported full year results. Remember, it's computer gaming. So, during the pandemic and coming out of it, there's been a lot of spend in this area, and their revenues are up 19%, and their operating profits kind of tracking that, up 20% and generating a margin of 22%. So, and they've got, what you're looking for gaming companies, Andrew, is this, it's not only increasing in overall usage, but it's new games coming out. and a spread of new games, not necessarily relying on one franchise. And they've announced a number of launches that are coming out ahead, which will drive momentum. But you can see how valuations often work, and something like this is on these sort of multiples because of these margins. But 18% EPS growth, it's on a P of 38 times. So
it's
investors
to 10p today, and actually it hasn't been a great performer for the last couple of years, or so the last year or so. But I mean, it's been a 10 bagger since 2017. So don't get me wrong. Have they got exposure to China though? Because obviously China is cracking down on the amount of time that children can play these video games, aren't they?
Yeah, they are, and I don't know if they do have, Andrew. I'll be frank, I'm not sure, but I don't know.
I mean, it's obviously China is going through quite a cultural change. President Xi Jinping, who's done an incredible job, really, when you think about it. Is just changing the culture of China to sort of get away from, I suppose, certain Western habits, which he feels aren't appropriate for the Chinese people, which is fully understandable, by the way. And video gaming, he doesn't want too much of that. He's trying to get away from some of this excessive after-school teaching, and also moving some of the wealth away from the super rich into the less rich. A lot of it actually is very sensible sort of stuff. But obviously, it's going to have an impact on certain companies. I just wonder whether that is true with Frontier Development.
Yeah, don't know the answers to that one, but something for investors to take a look at. Another one, which we've discussed, is Midwich. Ticker on that is MIDWM. It's 540 million market cap. And Midwich are involved in supplying businesses, many thousands. They've got something like 20,000 customers with audio-visual, AV equipment, printers, digital signage, sound equipment, and of course, even in our office, Andrew, we've got our screens up and of course our broadcast equipment that we use for podcasts. But that's the sort of kit that Midwich supplies, and it's brands like Bosch and Sony. They have interim results now. As we've been coming out of the pandemic and people are getting back into offices, they are obviously starting to spend money. But they, big displays are used, for instance, in as we know, for corporate presentations, but also in education. And in the entertainment sector, so they're kind of markets that they're into. But they've seen their sales grow by 29% in their 6 months to June. So you remember they're comparing this with June of 2020, the period, the 6 months ending then, and that covered the real crash in terms of COVID and demand. And so sales recovered by 29%. The gross profits tracking ahead of that, up 35%. And they made an operating loss in that period of June 20, and no surprise given just how bad the environment would have been for a business like this. They moved into an operating profit of £7.6 million. So nice recovery in growth. And as I say, we kind of highlighted this one before. But looking at that again on valuations, Andrew, the gross margin for this is just under 16%. So it's low versus, for instance, something like Frontier Development, it's making 63%. So on the EV to revenue multiple of 0.76 times, falling to 0.71. But the forecasts on Bloomberg are for 22% EPS growth, and the P is 22 times. That's a peg of 1, which, we look at that ratio of PE to growth is always, investors look for a multiple of kind of 1 or less, so a reasonable, an interesting level.
Pegs? I mean, this is going back to fundamentals, Phil.
Thank you.
Are you telling me the markets can go back to sensible valuations again, not just sort of multiples of revenue? It's no fun at all.
No, it isn't. But unfortunately, that's what those analysts do every now and again. So
no volume at all today in Midwich. I mean, it's gone completely. It clearly has either a very, very stable shareholder base, should we say, or hasn't attracted the interest of investors today. Although the market's a pretty horrible day today, it has to be said.
Yeah. So and then just one final one from me is Gamma Communications. And this is 2 billion market cap, ticker is GAMA. And again, this is all about it's IT to businesses, and what they provide to businesses is high-speed comms network, cabling for want of a better word, but connections. These are called SIP trunks, and they do hosted IP voice systems. So things like, we've got an internal switchboard here, Andrew, but they offer that as a cloud-based system. They provide mobile services, but they serve a vast range of SME businesses, UK, Germany, and Spain, and they had their interim results. And these were quite interesting, and the market reacted on these if you look at the share price chart. And Gamma's enjoyed a really, really good run. It makes gross margins of 50%. And it's got good high profit margins. So there's a lot in here to like in terms of Gamma's sort of core metrics, financial metrics, and it has very high recurring revenues. So looking at these interim results, they saw their revenues up 23%, gross profit up 20%, all nicely double-digit increases there, and a high cash generation. But it's quite interesting, within that, there are acquisitions. They've made acquisitions, so you always have to kind of strip that out, look at the organic levels of growth to try to get a feel for what's happening. And of the turnover of 270 million, 130 of that was from UK sort of indirect. They've got a huge distribution network they use for UK SMEs naturally, but that was up 9%, and the gross margin was up 7%. So I just wonder if investors felt, and there's already been a kind of upgrade on this one, that it just, a bit of a pause for breath, as they say, because if you look at their valuation, high gross margins, right? But it's on EV to NR revenue multiple of 4 times, falling to 4.4 times, falling to 4, but 8.5% EPS growth forecast. This is on Bloomberg, and a P of 34 times, falling to 29.7. So.
Well, I've said this to you before, Phil. Why didn't you tell me this about 10 years ago? Because it's been a 10 bagger since 10 years ago. It goes from the bottom left hand of the chart at about 200p to the top right hand chart at currently 2100p. So you've got to tell me about these things earlier, Phil.
But we should have met earlier, Andrew. This is the problem.
That's what all girls say.
Thank you. Well, I started at VSA a year and a half ago, so we should have met some time ago, because I've known that company for a while. So that's most of it from me. We are in September. There will be more interim results coming through from the market. So and we're quite keen to look at those and see how they're reflecting what's happening in the economy, because I think right now investors have got sort of two things on their mind, and you correct me, Andrew. I mean, firstly, it's inflation, and is that going to be lasting? But then it's the pace of growth going forward. We've come to a very sharp pace of growth because we've been recovering from the COVID-led recession, but it's like what's going to happen ahead of that in terms of growth and sustained growth.
Yeah, look, I think the market is, everybody's come back in September thinking, whoa, let's go again with the market. But one of the problems that I always remind people on the market in general is that for the last 12 months, institutions haven't suddenly thought, hey, let's support every single deal and everything's cheap, let's go for every IPO just because suddenly everything changed. Actually, what happened was that they had a huge inflow of funds into their funds, and they're not paid to manage cash. So they had all this cash, they had to put it in the market. So that's why they were happy to support all the deals. That inflow of cash into the funds has slowed right down. So now effectively when a fund manager has a deal come along, he's got to say, look, I could take this deal, but I probably have to sell something in order to fund it. And that's a very different decision to what he's had to do in the last 12 to 18 months. And so we are unfortunately going to see, these days of stock prices doubling almost overnight really probably are finished. You may see stocks coming off because people are selling because they just see it as boring for the next 12 months, which is really disappointing. It's very unfair on the company, but it will happen. The only thing that will actually against that, and where I do think we are going to see a lot of M&A activity. I mean, I can't say what, but we have M&A deals on our books. I talk to a lot of the other CEOs of the big brokers around town because I've known them a long, long time, and I can tell you they've got deals on their books, and there's going to be a lot of M&A activity. And so picking stocks that could get bid for was key. I mean, there was a big one today. It hasn't actually been bid for, but EasyJet came out. this is an interesting conundrum, nothing really to do with technology, although I'll put a technology spin on the end of it all. But, they came out today and said we're raising 400 million or something in a rights issue. Well, maybe it was more than that, I can't remember. Very heavily discounted rights issue, by the way. And they sort of put a spin on it at the end to get everybody to come in and take stock, was that, oh, and by the way, we had a bid approach, but it wasn't high enough, from, rumored to be VSA. Quite a crafty way to get people to invest. But I think that is the sort of thing you're going to see. You are going to see that sort of M&A activity, and people may use it in order to raise money, as EasyJet have done. What's interesting, I can tell you, I mean, I nothing to do with technology, but I follow the travel industry very, very closely. I have done for sort of 40 years. And all of these travel companies are going to come around and ask for more money, I'm afraid, because it has been a disastrous summer, really, and they struggled during the winter. The one stock that amazes me, it's had about 4 profits warnings, but they sort of claim that because they're so regular with their profits warnings, it's actually just underlying trading. It's bizarre. Is On the Beach. On the Beach is a technology travel agent, basically. It's actually up today when all the other travel stocks are down. I really cannot understand On the Beach and why it is valued at what it is, because it is basically just a travel agent. Anyway, that was a little bit of a rant, completely off piece. Sorry about that.
I thought valid comment. I think, and particularly on the M&A front, there is, I mean, the US. Obviously, we've been talking about the US money that's coming in, looking at UK companies, and privately, the record levels of activity in M&A. And of course, we've got huge amounts of money sat there in private equity funds to be deployed, and new funds getting raised in private equity as well. So yeah, that's.
Actually, I'll finish up sort of talking private equity. I'll finish up with one more thing. We probably ought to come to a close. And it's a combination of factors put together. But I see the IP group, which we've talked about quite a lot, and I've been a big fan of, it's now got up to about 150p. There was also a very good float of a company called Forward Partners, came out of Liberum actually, that was floated at £1, and they've now got to 117.5. But the concept of a lot of these, and it's sort of all to do with Frontier IP, Draper Esprit, Mercia. We're seeing these funds or ways to become a venture capital sort of GPLP into early stage tech in order to get exposure. Because as an individual, to invest in one early stage technology company, you are running one hell of a risk. But to be able to invest in a portfolio is very attractive. And obviously a lot of these groups, they all invest at slightly different stages. We're looking at one called Superseed. Whether there's something we can do there, they're very early stage. But if you get one at very early stage correct, my goodness me, you're going to make a lot of money. It's a very interesting space at the moment to look at these funds of basically venture capitals, and I think there's quite a lot of money to be made on them.
Yeah, there is. As you say, it's a super way of getting exposure to earlier stage businesses without necessarily having the risk of investing in one at a time. And it's very, very encouraging, I think, because getting access to investment for early stage companies can often be a challenge. So I think it's good to see.
And on that note, we'll call it a day. As I always say, if anybody's got any thoughts on our podcast, please let us know. Anybody wants us to go and look at anything or talk about anything, please let us know. And great to have you back, Phil, although I'm going to carry on searching for special guests because it's quite fun doing a special guest one.
It is. All right, Andrew.